Hello, everyone, and thanks for joining us today. My name is Savannah Bekowski, and I work at the Syracuse University Environmental Finance Center. On behalf of the Environmental Finance Center Network and in partnership with the EPA, welcome to the webinar today on funding and financing strategies for integrated hazard mitigation and water resource plans. This webinar is part of an EPA training series aimed at tying together water resource plans and hazard mitigation plans. The resources and strategies discussed today can be adopted by small water systems and can be used to think through a number of community funding needs. During the webinar today, everyone will be kept on mute to ensure audio quality. If you have a question, please type it into the GoToWebinar question dialog box at any time throughout the session. We will be posting the presentation as well as a video recording on our website, and you can reach that website in the bottom left-hand corner, the efcnetwork.org. You will be receiving a follow-up email that includes a link to all of these materials. We do not submit our webinars to licensing agencies for pre-approval of continuing education credits. We do provide certificates of attendance as a courtesy. It can take 1 to 2 weeks to send out certificates of attendance, and you must attend this entire webinar to receive one. You must have joined this webinar using the unique join link that was emailed to you when you registered, for that's how we count your attendance. We cannot guarantee that this webinar will meet requirements for a specific CEU or licensing renewal needs, but if you have any questions about this, you can email us at smallsystems@syr.edu. And for a little bit about us here in the Environmental Finance Center Network, our program provides training and technical assistance to small public water systems in all US states and territories to help local water systems achieve their goals and stay in compliance with the Safe Drinking Water Act. And here you can see the various centers that make up the Environmental Finance Center Network. You can see that we have centers and partner organizations spread across the entire country for this year's programming. We all work together to create solutions for difficult how-to-pay issues of environmental protection and improvement. And on that note, I would like to introduce our speakers for today's call. First, we have Matt Confirst, physical scientist for the US EPA Region 3 State and Watershed Partnership Section. Matt will be providing a brief overview of the EPA training series, and then we will be joined by Brandy Esplanilla and Pia Yolster for the presentation and Q&A session. Brandy is the Sustainability and Resilience Program Manager at the University of Maryland Environmental Finance Center, and Pia is also a Program Manager at the University of Maryland Environmental Finance Center. So I welcome them all, and I pass it over to Matt.
Hi, everybody. Thank you for joining us today for our webinar, Funding and Financing Strategies for Integrated Hazard Mitigation and Water Resource Plans. My name is Matt Confirst. I work for the State and Watershed Partnership section at US EPA's Region 3 office in Philadelphia. And I'd just like to take a couple of minutes to describe a bit about the background of this project before introducing our speaker. So state and federal agencies, including EPA, FEMA, the US Army Corps of Engineers, and state emergency management agencies in Maryland, Pennsylvania, and Virginia have been partnering to more consciously incorporate major federal water quality programs into hazard mitigation plans. In other words, integrating water quality planning with water quantity planning to better align resources and departments and take full advantage of the multiple benefits that environmental planning can provide. Nature-based solutions, including green infrastructure and low-impact development, provide a way to link these two planning processes. Nature-based solutions aim to impacts from natural hazards while protecting, managing, and restoring natural or modified ecosystems. These actions also provide human well-being and biodiversity co-benefits. Green infrastructure mimics the function of a natural system. For example, the installation of a rain garden provides a solution that mimics natural hydrologic systems and helps to reduce localized flooding through natural infiltration. Other examples where green infrastructure can be applied include preserving and restoring uplands, streams, and their floodplains to maintain pre-development flood flow volumes and normalize stream flow, restoring native vegetation for erosion, wildfire, and drought control, using trees and green roofs as urban infrastructure to reduce urban heat island effects, and managing agricultural land use practices that enhance soil health while reducing excess runoff volumes. Is being finalized and developed into training materials to provide an in-depth look at the synergies between water resource plans and hazard mitigation plans. Case studies and examples are liberally sprinkled throughout the materials to link the concepts to practice. Module 1 gives an overview of natural hazards affecting water resources, as well as discusses nature-based solutions and the benefits of incorporating them into hazard mitigation planning. Module 2 describes major water quality programs under the Clean Water Act and Safe Drinking Water Act and how they overlap with hazard mitigation planning. Water quality programs can include non-point source pollution, MS4 stormwater permitting, drinking water, source water protection, wetlands protection and restoration, as well as programs to guide restoration of impaired waters to meet water quality standards and TMDLs. Module 3 provides information on the FEMA Community Rating System, or CRS program, an incentive program for communities under the National Flood Insurance Program, and the overlap of the CRS program with various water resource programs. Module 4 describes the lessons learned from pilot projects supported by EPA and FEMA to integrate green infrastructure, low impact development, and watershed planning into hazard mitigation plans. Module 5 provides examples of state and local hazard mitigation plans that do integrate water quality programs. And Module 6 provides information about funding and financing options and how more of these options become available when surface water quality, drinking water source protection, wetlands protection, and other aquatic ecosystem services are included in project objectives, compared to addressing flood damage reduction or hazard mitigation alone. So to talk about Module 6, I'd like to introduce Brandy Espinola, Sustainability and Resilience Program Manager at University of Maryland's Environmental Finance Center. Brandy joined the EFC at the University of Maryland in 2012, and she has over 8 years of experience working at the federal, state, and local level, providing technical assistance across a broad array of social, environmental, and fiscal policy research and analysis. As Resilience and Sustainability Program Manager, Brandy works closely with local stakeholders to identify key issues, goals, and obstacles in order to facilitate and fund local solutions. Brandy received her MS in Sustainable Development and Conservation Biology and an MPP in Environmental Policy and Nonprofit Management from the University of Maryland. And with that, I will turn it over to Brandy.
Thank you, Matt, for that introduction, and thank you all for attending this webinar, Funding and Financing Strategies for Integrated Hazard Mitigation and Water Resource Plans. As Matt and Savannah mentioned, this webinar, which is part of a larger EPA training series, is intended to show how local decision makers can pay for integrated hazard mitigation and water resource projects. Whether you manage a small water system, act as your local mitigation planner, or direct a large regional district, the basic principles and strategies discussed in this webinar can address your community's funding needs in order to move from planning to implementation. Our goal will be to introduce you to funding and financing strategies that are likely to apply to any jurisdiction, big or small, and provide examples of how communities have adopted these strategies to protect source water, mitigate flooding, and tackle a number of other local issues. I'm going to go ahead and apologize ahead of time. I did the cardinal sin of having probably too many text words on the slide deck, but I really think that there's a lot of information and a lot of great case studies we wanted to make sure we shared with you today. So what exactly is integrated hazard mitigation and water resource planning, and why is it beneficial? Integrated planning is an approach to planning that provides a comprehensive view of resources and commitments to ensure financial and capital resources are aligned with community priorities. As opposed to the fragmented planning process, which many of our communities typically use, integrated planning incorporates elements that are common to multiple planning objectives, in this case, hazard mitigation and water management, to align common elements and identify mutual or overlapping activities. So integrated hazard mitigation and water resource planning comes with a number of community co-benefits. It can help reduce confusion and redundancies in community priorities. It can create broader range of support since it draws on a larger set of community goals. It reduces hazard impacts and addresses water quality mandates, and it can increase overall community resilience. Integrated planning also has significant economic benefits. So some of those financial benefits include helping to streamline resource allocation and coordinate available project funding to accomplish more than one goal. It also allows communities to leverage different funding sources that may not have been considered for a single benefit program, and it can increase access to financial options. So for example, you might be able to tap into local source water protection grants and federal hazard mitigation technical assistance programs to implement the same project because you have defined the issue as a water quality and a mitigation challenge in your integrated plan. Integrated plans can also help you scale water and hazard mitigation projects to facilitate access to additional resources, attract large-scale investors, and potentially shift from funding to financing. So some utilities are already even integrating plans with other communities and partners in the area in order to achieve scale. Regional climate collaboratives are great examples of this strategy in practice. So to address the problems of increasing extreme weather events, communities across multiple jurisdictions have started to work together at a regional scale to put in place programs, and communities can achieve integrated solutions to address those climate change objectives while overcoming limited resources and technical capacity needs. So we already mentioned that most communities use generally a fragmented planning process that only looks at one general issue at a time. For example, stormwater, drinking water, or community resilience, each independently. So while there are many models for planning, they all typically break down into 5 major steps. 1, identify issues and existing conditions. 2, describe your needs and state your planning goals. 3, collect data and evaluate potential strategies. 4, develop your plan with recommended solutions. And then 5, adopt the plans after some community comment period. It's not until after a plan is adopted that we think about implementation, including timelines for strategy adoption, project financing, and monitoring and evaluation. That means whenever we talk about project finance and budgeting, it's typically after we have undergone the typical planning process. This oftentimes leaves us chasing the money. It is a very common problem. Many of us undergo an elaborate planning process and then have well thought out strategies, but then when we try to go ahead and implement our solutions, we can't because we haven't thought through the various funding and financing sources. So as communities across the country face increasing costs associated with maintaining safe and clean water, preparing for increased extreme weather events, and managing failing infrastructure systems, we will need to mobilize support and resources around plans that can address these growing concerns comprehensively. Rather than maintaining the typical planning process, where a community develops the plan first and then considers implementation and costs after the fact, it is important that we shift the discussion about financing and funding earlier on in the planning process. This can help us to integrate community goals, leverage project funds, and reduce overall implementation costs. Incorporating funding and financing strategies into integrated planning efforts will enable communities to successfully implement projects, build resilience, and respond to potential threats while maximizing efficiency. So if your community has already assessed their climate risks and vulnerabilities, and they've developed an integrated strategy to preserve government services while protecting people and property against flooding, extreme storms, drought, and heat, the information in this webinar can help you to identify opportunities to pay for those proposed strategies and recommendations. But if your community has not yet completed an integrated hazard mitigation and water management plan, the information in this module can inform your plan development process and enable you to consider what types of funding and financing strategies you may want to integrate early on in the process. To integrate funding and financing earlier on in the planning process, you'll want to identify general costs as part of the data collection process and develop estimated budgets. Insufficient funding and the lack of strategic financing plans can often be a barrier to integrating nature-based solutions and other green infrastructure and low-impact development strategies into your traditional infrastructure projects. So, however, once your community has identified specific hazard and water resource concerns and developed potential interventions to address these concerns, you can determine cost estimates of specific actions and overlapping strategies. Consider the types of costs for each of those planned interventions, including your capital costs, labor, and operations and maintenance, and then develop comprehensive budgets for that first year as well as a long-term budget projection so that you can include things like inflation and additional contingencies. You'll then want to conduct a basic benefit cost analysis to thoroughly evaluate potential strategies prior to proposing solutions. Funding will likely depend on the benefits or avoided losses that your community can demonstrate, so understanding the expected outcomes of your integrated hazard mitigation and water resource strategies can help your community prioritize projects with the greatest impact and focus, and help focus your plan on the implementation of high impact practices. So assess the qualitative and quantitative benefits of the proposed implementation strategies. To do this, you'll want to review historical loss records, national case studies, and other available data sources. You'll also want to include up-to-date climate change projections to accurately account for future risks mitigated by the proposed implementation strategies. And then consider potential funder guidelines for benefit valuation. So for example, FEMA benefits are mainly measured through avoided losses of insured structures through the National Flood Insurance Program. And these are sort of easily quantified, and they have very specific guidelines for how to do that evaluation process. Other funding sources such as the EPA grants and loans do not use formal numeric benefit cost analysis, but have more qualitative requirements for assessing the project benefits. Once you've come up with your benefit cost analysis, compare the future benefits of proposed projects to implementation costs. If the benefit cost analysis is less than 1, you might want to try to figure out how to make it more advantageous by identifying more stakeholders or co-benefits to calculate into your assessment, or reduce the costs such as partially funding the project from another source or identifying in-kind services to reduce the funds requested. If possible, consider doing a total cost benefit analysis, which would look at your social and environmental costs and would estimate costs and benefits over the lifetime of an asset rather than just over a specified period of time. And then you want to develop a basic funding strategy to incorporate into the plan. It's important to identify a wide set of funding and financing mechanisms, which we will discuss a few later on in this webinar, and determine how to best combine them over to cover the costs and allow you to prioritize options. A well-defined funding strategy may be required by specific funding sources, and even if it's not required, developing a detailed funding strategy can help you match projects and appropriate funding sources to the projects you're trying to implement. So avoid limiting your options too soon. Consider cost-saving approaches, revenue streams, and innovative strategies, and then see what is out there and think about using a blended portfolio approach that would combine multiple sources of funding and financing options to cover the cost of the projects. Also, you want to understand how funding sources can and cannot be combined. For example, some federal grants are not to be combined with other federal grants to fund a single project, and there are restrictions on what can be used as matching funds. So you want to make sure you understand those guidelines ahead of time. Identify available clearinghouses for your state's grants and loans, and then evaluate your strategy for any major funding gaps. It's also important to understand what funding and finance options are available to your community. So funding is financial resources that are not required to be paid back. These are things like taxes, fees, and grants. Whereas financing is the acquisition of money for a program or project that does require repayment of principal and interest, and these would be things like loans and bonds. So to develop a sustainable financing and funding strategy, you'll want to consider all these different types of mechanisms, and you'll want to consider your desired activities and associated budget needs, existing sources of funding or in-kind support, and your community's appetite for new revenue programs. In the rest of the webinar, we will highlight key financing and funding strategies and examples of communities that are successfully utilizing these approaches to implement projects. The mechanisms are broken down into 2 main categories: cost reducers, and revenue streams. Cost reduction strategies increase programs' efficiency and reduce its overall costs. While not explicitly sources of funding, these approaches help stretch public funds and leverage outside resources. Revenue streams, on the other hand, are mechanisms to generate and access capital for project implementation. We will also share examples at the end of the presentation of the webinar on blended finance approaches, which simply refers to the idea of combining multiple finance and funding sources. Keep in mind throughout this webinar that while you may be familiar with several of the common financing approaches, this webinar is intended to build a basic understanding of the various strategies so that you can, 1, incorporate financing considerations into earlier stages of the planning process, and 2, combine and leverage strategy strengths that can help reinforce the implementation of comprehensive plans. Assembling the appropriate mix of cost reduction and funding strategies is highly dependent on your community's particular needs and characteristics. It won't look the same for everybody. So, cost reduction strategies is our first category of strategies, and these can increase effectiveness and reduce spending. It's important to think comprehensively and creatively as you think through your cost reduction strategies. Some cost reducers may require larger initial investment of your time in order to get set up and resources, but it might also be important to incorporate these types of strategies so that over the long term, you'll see savings that are generated by these cost reducing strategies. So our first cost reducing strategy is comprehensive plans. These help to address growth, land use needs, and the increasing impacts posed by water resource management and extreme natural events. Comprehensive plans are the mother of all integrated plans, and so some of the financial and community benefits discussed earlier in the webinar are the same for comprehensive plans. Namely, they clarify priorities, establish commitments, recommend integrated strategies, provide a single point of stakeholder engagement rather than engagement for each project in a standalone fashion, and it facilitates coordination among departments. Local governments can use these planning processes to explicitly address their hazard mitigation and water resource needs. By incorporating such challenges into local comprehensive plans, solutions can then be incorporated into integrated long-term plans, which will increase cost effectiveness and save unnecessary expenses in future years. So 2 examples of comprehensive planning are in the state of Washington and in the state of Maryland, both of which have a long record of requiring additional integrated elements into their plan. In 1990, Washington State established the Growth Management Act, which required each city and county within the state to prepare a comprehensive plan that regulates development, conserves natural resources, and guides economic growth, designating critical areas for protection, including frequently flooded areas, geologically hazardous areas, and critical aquifer recharge areas. In Maryland, they passed the Maryland Smart Growth legislation in 1997, which focused on incentives rather than regulation by targeting state funding to encourage growth and investment in existing urbanized areas while encouraging the preservation of rural legacy areas. So smart growth helps to concentrate development and conserve open space in priority funding areas, which requires sewer and water plans, all of which aim to limit sprawl and reduce impervious surface and pollution from runoff, which helps manage stormwater systems and can help with water quality. So a capital improvement program is another type of cost reducer. And these identify and prioritize communities' needs for publicly financed physical infrastructure by coordinating investment projects across multiple priorities. CIPs can help reduce redundancies and increase efficiency. How many of you guys are involved in your CIP process? Well, if you are, you should try to adopt a dig once approach and take into consideration the risks of natural hazards. Then these 2 things can help you lower the cost of project implementation and can help ensure investments in more secure over time. So for those of you who are not familiar with the term dig once, it refers to actively incorporating additional benefits to pre-scheduled infrastructure projects. For example, if your community is expected to undergo road maintenance where the ground will need to be excavated, then this presents an opportunity to integrate green infrastructure to address stormwater runoff. It's an opportunity to change out old drinking water pipes or even possibly lay down new broadband lines. This approach of piggybacking additional benefits on an existing project allows you to leverage existing funding, and it can lead to greater efficiency and overall cost benefits. Municipalities who are considering incorporating this into their CIP process could create evaluation criteria that prioritizes projects that address hazard mitigation and water quality concerns to ensure that these considerations are embedded in all future capital projects. So 2 examples of the CIP process being used to incorporate water management and hazard mitigation considerations are in Prince George's County, Maryland, where they amended its county code in 2012 with a new ordinance that incorporates green streets and pedestrian safety under the planning for roads and sidewalks. And so in 2014, Capitol Heights, a municipality within Prince George's County, was officially adopted a complete streets policy because of this code. And then in the state of Vermont, they established its hazard mitigation plan in 2018, which will be implemented by collaborative efforts among different state agencies. Among other measures identified in that plan, municipal planning and capital improvements will be incorporated into the use, as part of this process. So for the state of Vermont, they're considering using river corridor tool and a road infrastructure tool to identify sites most vulnerable to flood damage within their CIP process. Another cost reducer is cooperative procurement and interlocal resource sharing. These tools are tools that local governments can use to reduce time, administrative overhead, and other costs. Cooperative purchasing combines the requirements of 2 or more public entities to leverage the benefits of volume purchases, delivery and supply chain advantages, best practices, and the reduction of administrative time and expenses. Cooperatives can pool demand for a product or service in order to get lower prices from suppliers. For example, several local governments in watersheds in a similar watershed can work collectively to hire a contractor which would design bioretention areas, and they would benefit from better negotiation positions because they're coming at it together with sort of economies of scale. An interlocal service agreements are where the participants agree to share service responsibility or contract with a neighboring government to provide the service to another jurisdiction. An example of an interlocal resource sharing strategy is, for example, when several smaller jurisdictions need to purchase a snowplow, but they might not be able to afford that independently. So they pool together in order to purchase one snowplow and share it amongst the jurisdictions. So similar to cooperative purchasing, interlocal service agreements can increase economies of scale and can help to provide high service levels, optimization of facilities, and increased accountability. A good example of this would be in Minnesota's watershed districts, where they provided cost share funding to cities, counties, and other entities for stormwater management practices. The Minnesota Cities Stormwater Coalition was formed specifically to help cities manage their requirements under the federal MS4 permit requirements. So rather than having each jurisdiction hire their own consultant, they sort of leveraged their resources in order to use the Minnesota Cities Stormwater Coalition to fill that role. So another cost reducer strategy is the public-private partnership. While many people think that public-private partnerships are a financing mechanism, they're actually a cost reducer. The value of a P3 is the ability to bundle together the design, build, financing operations, and maintenance of an infrastructure asset in a more cost-effective way than if the public sector was to try to do that on their own. A well-structured P3 will have both partners sharing the risks and rewards of the implemented projects. The local government will usually maintain ownership over the asset, and the private company will normally take on some part of the actual implementation of the project. The private company oftentimes receives regularly scheduled concession payments from the local government, which can be funded through a toll, user fee, rate payment, or tax revenue. And so P3s benefit municipalities because municipalities can defer upfront costs, and investors are normally attracted to P3s because it provides a high level of transparency, it gives them investment premiums, and it secured repayment streams. In addition to traditional P3, local jurisdictions may want to explore community-based public-private partnerships, which go above and beyond the basic requirements of a P3 to include alignment of goals, accountability, transparency, and sustainability. So a CBP3 are thus uniquely positioned to address environmental community-based challenges. For example, in 2012, Prince George's County, Maryland created the Clean Water Partnership as a groundbreaking community-based public-private partnership program to meet regulatory requirements by leveraging private sector resources and promoting operational efficiencies and innovation in design, construction, and maintenance. The county needed to retrofit 15,000 acres of impervious surface area in order to comply with the Clean Water Act regulations, but we're also interested in investing in communities and building a local workforce capable of maintaining green infrastructure. The public-private partnership relies on funding from a stormwater utility. The county provides the oversight and is in charge of managing the private partner, and they provide a way of streamlining costs and improving the efficiency of the investment. So another well-known cost reducer is rebates and tax credits. While these do not actually lower the cost directly of the local jurisdiction, it does provide incentives for communities and private property owners to make investments or adopt certain best management practices that benefit the community. By helping people to get part of their money back in the form of rebates and tax relief of various kinds, local governments can make it easier for residents to spend their own money on or contribute to the environmental projects, both reducing the cost to the jurisdiction and increasing the impact for the community. Projects implemented on private properties can complement those on public lands and reduce the need for larger public investments. When designed well, incentive programs can lead both to private investments in best management practices beyond what would have been achieved in the absence of the rebate program. This above and beyond is known as additionality, and to private investment into related best management technologies that are unsubsidized, known as the acceleration effect. So using rebates and tax credits can help increase the investment in these goals and environmental goals that we're trying to achieve. So more and more recently, municipalities have developed rebate programs to incentivize the implementation of water conservation and stormwater management practices. Here you'll see a couple different examples, specifically the borough of Westchester in Pennsylvania and Anne Arundel County in Maryland, both adopted stormwater fees, which also include a rebate program. So the initial fee is directly proportional to the impervious surface area of their parcel, and then they're able to receive discounts on that fee, provided that they implement green infrastructure practices on their property. Another form of a rebate is a community rating system. The FEMA's National Flood Insurance Program rewards communities that undertake floodplain and watershed management activities that exceed the minimum floodplain management requirements by reducing their costs. Residents obtain increased discounts on their flood insurance premiums based on the increased amount of hazard mitigation activities they implement. And so the final cost reducer we will cover today are regulations and policies. Policies can be adopted by local jurisdictions to formalize the community's hazard mitigation and water management goals. It reduces the capital cost of implementing integrated hazard mitigation plans and encourages private sector investment in the community. Updating code, instituting dig once policies, and streamlining permitting processes can help advance a community's goal without significant investment of public dollars. And they can even provide a funding stream in the form of enforcement fines, mitigation payments, and in lieu of payments. Incorporating updated standards and having local codes that require or allow developers to minimize impervious cover, conserve natural areas, and reuse runoff reduction practices to manage stormwater runoff can help reduce construction costs, leverage private investments for implementing projects with public benefit, and ensure more resilient communities. So in 2014, Both the tree canopy law and the county's roadside tree protection law went into effect in Montgomery County, Maryland. Both of these laws established sediment control permit requirements, which require limiting disturbance by planting trees or paying fee in lieu of payments into a dedicated account. And so as of fiscal year 2018, the mitigation fees paid because of the tree canopy law totaled approximately $2.2 million. This allowed them to fund their tree canopy staff. It also allowed them to plant over 2,000 shade trees. And so this is an example of a law that was enacted that allowed them and enabled them to not just get a revenue stream, but also put in place regulations to have private property owners manage their environmental goals on site. So those were the cost reducing strategies, and those all, do not produce directly a revenue stream. Our next section will talk about revenue streams, which are mechanisms to generate and access capital for direct project implementation. In general, local jurisdictions rely on two methods of funding or financing infrastructure. They can use a pay-as-you-go or a cash strategy, or they can use a pay-as-you-use, a debt strategy. And local jurisdictions' size, their geography, their land use, their legal frameworks, coverage of government services, and citizens' preferences can all influence what sort of balance they have in terms of their revenue structure. So we're all familiar with taxes. General funds are typically the main source of income for municipal governments and generally come from property income and sales tax. Competing local priorities make it difficult to rely on general funds, leading to unstable resource allocation in many cases. In addition, hazard mitigation and water management costs have been increasing at a higher pace than general funds, and relying exclusively on these will most likely prove insufficient for your integrated management plans. Additional, more reliable taxes might include selective sales tax, such as those levied on the sale of commodities and services, a special assessment tax, which are local level taxes imposed on residents in order to fund an infrastructure or other project that will improve the community. These types of taxes should really be linked to the cost of providing the service or infrastructure and applied uniformly to all beneficiaries. Then there's a tax increment financing districts in which the cost of improvements are paid back by future tax increases. And then special improvement districts in which members of the group are assessed fees in order to pay for desired benefits, including green space and trees. In general, taxes are unpopular, and given the current economic climate, it is unlikely to garner any public support in the near future, but it is a standard revenue stream that we all are familiar with. And so Fairfax County, Virginia, for example, needed more stringent regulatory requirements and essential reinvestment in the county's aging infrastructure. So this resulted in the need to establish a funding mechanism that was independent of their general fund. In 2010, they implemented a stormwater tax, which is now currently assessed at 3.25 cents per $100 of assessed real estate value. So fees differ from taxes in that they are assessed in order to recover some of the costs of providing a service to beneficiaries rather than simply raising revenue for general funds. This is sometimes politically more feasible and more popular because it's sort of a pay-as-you-play system. So using dedicated fees is preferable because it avoids competing with other programs and needs that compete for general funds. Local governments can levy fees for a variety of reasons. Ideally, in order to be better accepted, fees should be linked directly to the cost of providing the service and used exclusively for that service, as well as applied uniformly and fairly to all beneficiaries. So things like permit fees are assessed by local governments to raise revenue directly from any proposed development or construction that may worsen or create environmental impacts. Drinking water is a well-known utility fee, and the challenge there is, of course, always trying to establish a price that covers the full utility costs. while still maintaining equity within the ratepayers. There are impact fees, which are traditionally one-time charges for developers used to pay for improvements to services and amenities necessary to serve new development. And then there are the fee in lieu of, which we've mentioned a couple times before, but these are fees that a developer or other person property owner has to pay in order to compensate for the environmental impact a development project may have incurred. So Northampton, Massachusetts established a stormwater and flood control utility in 2014 to support their stormwater management and resilience efforts. The average runoff for a single family, 2-family, and 3-family homes was determined, and then fees were based on those averages. In Missouri, Missouri funds their stream restoration projects with a mitigation requirement for developers that impact streams. Mitigation may include paying into a fee in lieu of system. This is sometimes used for stormwater management programs. If there is a retention requirement, at times it can be met with paying that in lieu of fee or increased amount of stormwater storage and infiltration on site instead of the fee in lieu of. So debt is the sort of other type of revenue stream in which you do need to pay it back. And debt can come either through bonds or loans. There are different attitudes towards whether or not you should use pay-as-you-use strategies, because issuing debt and paying off the debt over the project's lifetime might increase the total cost of the asset through the interest payments. But it also allows you to save time and build capital projects sooner by borrowing that upfront cost or upfront revenue. So green bonds are bonds whose proceeds are earmarked specifically for green projects and can be issued as general obligation or revenue bonds and are backed by the taxing authority of the community or state. While green bonds do not necessarily represent an additional financing benefit to the community, they do signal to the public that the community is committed to environmental improvement and can attract investors who are looking to invest in projects that provide positive environmental and social impacts. Environmental impact bonds are another instrument for financing large projects that pay returns based on outcomes. They are a form of pay for success debt financing. In other words, investors can only collect a return on their investment if the project proves to be successful. And typically these have an additional performance payment made to investors if projects achieve greater than expected performance. So in April 2019, the California Infrastructure and Economic Development Bank issued an $83 million green bonds for the Drinking Water State Revolving Fund program. The program provides low-cost financing for planning, design, construction, and implementation of critical drinking water infrastructure improvements necessary to mitigate drinking water risks to human health throughout the state. And then in Virginia, their Clean Water State Revolving Loan Fund has provided over $20 million in funding for the Cumberland Forest Project. They basically used this funding to purchase and protect about 22,000 acres of land in Southwest Virginia. And this is the largest open space easement ever recorded in Virginia. So these are two examples of how one might use a green bond or a state revolving loan fund in order to complete projects. I will say that green bonds, while pique a lot of interest for local jurisdictions, really do require quite large projects. And so using some sort of state or county green bank-like program might help you access those funds, because it can help you pool projects together and pull those resources across multiple jurisdictions in order to access those large funding mechanisms. And so everyone is probably already familiar with grants, and you probably complete a lot of your projects using grants. And so I won't go into a ton of detail about these, except to say that grants are normally non-repayable. That means you don't have to pay them back. And the processes of winning grants can be quite competitive depending on what types of grants you're going after. You can find grants at the federal level, state level, regional, local, and even through private foundations, nonprofit, or community foundation. Since grants can be accessed at different levels, and I know we have folks from all over the country on this call, I thought I would share this excellent resource with you all. It's the Environmental and Energy Study Institute. They put together a federal resources for nature-based solutions to climate change fact sheet. This fact sheet really does provide a survey of federal funding and technical assistance programs available to help state and local governments and agencies implement nature-based solutions for their climate resilience projects. Many of these sources of federal support allow communities to develop projects which draw on the multiple interrelated benefits of nature-based solutions. And this fact sheet does a really great job of really just sort of showing you what are the available resources and what types of projects you might want to use these types of resources for. So check out that fact sheet when you get a chance. It goes into a great level of detail for each of these different funding and technical assistance programs. Another form of philanthropic revenue is crowdfunding. So in recent years, crowdfunding or civic crowdfunding has made an appearance as a means to raise cash for programs that focus on the common good. Campaigns are typically launched for projects that don't require a substantial amount of fund. These are normally fundraised are between $5,000 and $30,000. And so the chief advantage of crowdfunding is that it raises public awareness, it helps garner public support, and it can be used as a source of matching funds. So IOB is a crowdfunding platform which helps connect local leaders with support and funding from their communities. Sustainable Connecticut, a voluntary program in the state of Connecticut, has really taken advantage of the crowdfunding platform in order to partner with their communities and give communities the opportunity for using IOB to offer a community match fund as a flexible funding mechanism for their sustainability projects. And then last but not least, we have offsite crediting programs or mitigation banking as a revenue stream. Now this isn't quite the same as a revenue stream, but it sort of, I think, falls best under this category. So mitigation banking compensates ecological loss resulting from offsite development activities. Following the completion of a project, credits can be generated and then purchased by permittees to compensate for impacts associated with projects in other sites. So this is sort of, kind of like an in lieu of fee, except for rather than payments being put into a fund, they're going to purchase these credits of a project that has already been installed. And so in Minneapolis, the Capital Region Watershed District allows companies to purchase and sell credit for ongoing projects, especially related to green infrastructure. The crediting system is designed for areas where it is difficult for new development to implement stormwater systems, like in developed downtown areas. This credit banking system fits here because most of the district is fully developed. And so folks who are unable to mitigate stormwater on their own site can go ahead and pay for these credits. Okay, so we have about 10 minutes left, and I'm going to try to breeze through some of these examples of blended finance. These case studies combine multiple finance and funding sources in order to implement projects. And so in the city of Charlotte, North Carolina, there was a housing and commercial buildings, lots of housing and commercial buildings were built in floodplains. They experienced repeated flooding losses, and the local county's stormwater services division started to buy and tear down those properties that were most vulnerable to flooding. Between 2008 and 2011, they purchased and tore down a very high-risk apartment system and restored the floodplain and stream channels and constructed water quality enhancements in that area. The project is now the Chantilly Ecological Sanctuary, and it comprises 24 acres. and is home to a thriving ecosystem. So as you can see in this table, they really did utilize a blended approach to funding this particular buyback and mitigation protection project. It included federal and state grants, utility fees, and fee in lieu of funds in order to do the entire buyback and restoration costs. Another example is the Bee Branch Watershed Flood Mitigation project in Dubuque, Iowa. So here is another example where the city was incredibly developed, and so they had ongoing flooding issues. The watershed encompasses historic neighborhoods, offering some of the community's most affordable, making some of the areas within this area incredibly prone to flooding. So in 11 years, the area had been hit by 5 flash floods, and they identified that over 1,150 homes and businesses were identified as especially vulnerable to severe flooding. So by 2003, a citizen advisory committee was set up to determine the best solution for the watershed. They looked at an open waterway or an underground sewer project, and they decided to go with the open channel solution. And so they hired a consulting firm. The project's total costs were $219 million, and to date, they've received $161 million to help fund and finance the project, including $52 million of federal and state funds, $98 million in the form of state sales tax increment financing spread over 20 years. And additionally, the Clean Water State Revolving Funds sponsored projects programs allowed the city to reallocate $9.4 million that was to be paid in interest for another project to instead be used to construct more than 70 green alleys in the Bee Branch watershed. So finally, they also received private donations, which were raised through the America's River campaign to plant trees and build amenities. So again, here's another example of a community that used multiple funding sources to really get deep environmental projects on the ground. And so the last example that I'll go through before we move on to questions is really the Vermont hazard mitigation statewide effort. So following Tropical Storm Irene, which had destructive flood damages in 2011, the state not only wanted to start a buyout effort to purchase flood damaged and flood vulnerable properties, but they also recently wanted to start mitigation initiatives that address the vulnerability in a more comprehensive way by restoring streams and floodplains. Floodplain restoration will conserve critical areas and watershed functions, but will also help reduce vulnerability of buildings and infrastructure that would otherwise be in harm's way. So since 2012, the state has been able to acquire and demolish close to 160 flood vulnerable properties and complete approximately 70 infrastructure improvement projects. FEMA has funded about 75% of most of these buyouts, and the rest has come from different federal and state programs. So they've been able to use, in this process, they've been able to use cost reducers such as community planning that integrates hazard mitigation and water resource management. They've been able to develop regulations that require no development be placed within these floodplain areas, and they've incentivized and promoted residential participation on their property. Revenue streams also that they tapped into included, as we mentioned earlier, the federal and state programs, which included FEMA, Housing Conservation Board, Vermont's Ecosystem Restoration Grants, and more. And they really did tap into the Emergency Relief and Assistance Fund in order to make this larger project happen. So in conclusion, in this webinar, we discussed the benefits of integrated hazard mitigation and water resource planning. We articulated the difference between financing and funding. We outlined a number of cost reducers and revenue streams and explored examples of how these strategies have been effectively used to pay for project implementation. There's no simple single solution to funding and financing municipalities' efforts to address water resource management. Problems and it's really difficult to prioritize different issues within your community. But by looking at these problems in a holistic way and integrating plans, communities can potentially reduce their costs of dealing with these challenges and increase the chances of accessing new sources of funding. So remember, early on in the planning process, look for ways to reduce costs, explore opportunities to work with adjacent municipalities, and or bring in the private sector to provide services in a more efficient way. Remain flexible and assess a variety of funding and financing sources to determine which ones may be accessible and worth implementing given the realities of your particular municipality or utility. And lastly, prioritize projects in order of urgency and funding potential in order to jumpstart hazard mitigation efforts and get communities working in the right direction towards solving your water management and hazard mitigation challenges. So again, I know I threw a lot out at you. We have lots of great case studies that will come in the slide deck that comes as a follow-up. But right now I'm going to turn it back over to Savannah.
Thanks, Brandy. Yeah, so before we jump into the Q&A, I will give folks just a little wrap up. Please submit your questions right now into the questions dialog box if you have any. We will be posting both the presentation and recording, as Brandy said, online, and you will receive a follow-up email with links to all of those materials. And right before we jump into Q&A, I do just want to let everybody know that the Environmental Finance Center does provide technical assistance for small water systems. And if you would like to learn more and get connected with experts on some of the topics that we discussed today or our other areas of expertise, please let us know here. And we'll leave this poll open for another few moments. And getting ready to close that in 3, 2, 1. And lastly, in the chat box, I have sent out an evaluation link. If you just have a few moments to let us know your thoughts and any feedback of today's webinar, that is very appreciated and beneficial to us. So at this point, Matt or Pia, I'm not sure, I see a few questions coming through if you wanted to, rattle those off to Brandy.
Okay, yeah, so if you have any questions, please submit them into the questions box. Yeah, I see a couple questions that popped up again about the slideshow. So again, follow those links in the chat box to get to the slideshow. Yeah, any burning questions? I see one about who should a city talk to start the process of integration, integrating co-benefits into our jurisdiction's hazard mitigation planning. The city's emergency management office, the city planning office, or a local watershed NGO.
Yeah. Matt,
yeah.
that's an excellent question. And so it really can come from any department, but the idea behind integrating it into the planning process is that it needs a collaborative team effort. And so you do, I mean, the folks that you just mentioned, folks from the emergency management office, the local watershed protection group, even the community, Department of Public Works and their financing team would all want to be involved in those early conversations about how to integrate the hazard mitigation and water management plans together.
Okay. And I don't see any other questions in the question box right now.
So at this point, if there are any follow-up questions, you can reach out to the presenter directly, or again, you can always email us at smallsystems@syr.edu. I do want to thank everyone on the call, Brandy, Matt, and Pia, for providing your expertise today. Brandy, I'll pass it over to you if you have any last wrap-up points.
Yeah, well, thank you all for taking your time to sit in on today's webinar. I know that you have plenty of other things to be doing with your busy days in this sheltering in place era. And so I'm sure you guys have been webinared out, but I appreciate you guys listening in. If you have any questions on any of the resources, as Savannah mentioned, feel free to reach out to me directly, to Chris, or to Pia. Thank you and have a lovely day.
Thanks, Brandy. Bye, everyone.